George Boubouras, Head of Investment Strategy and Consulting at UBS Wealth Management, joins us this morning. George, good to have you in the program. I guess there's talk again about a ratings downgrade coming from Moody's, Fitch now joining S&P, and there's skepticism as to whether or not Europe can get their act together. What are your thoughts?
Yeah, my thoughts, like everyone else, it's going to be very volatile. The European issue, we've just got to get our head around it. The reality is fiscal union, fiscal reform is nirvana. It's the long-term goal. You're not going to see good positive results until March to June next year. In the interim, markets will be extraordinarily volatile. That's not going to go away. It's going to be a bit unforgiving, so you need those circuit breakers. But the reality is, once a fiscal union is organised and consolidated in Europe, once they can get some agreement across the 17 EU members, then they can start moving towards more global central bank intervention. That's the circuit breaker. And then the ultimate is the silver bullet, and that is once fiscal reform is in place, then they can do unlimited bond buying program. And that's the key, just like the TARP in 2008 in the US. But the point is, going into 2012, elevated risks. Yeah. We've downgraded global growth. It's very uneven. We've got Europe in a recession. And for portfolios, you've got to really be defensive until the second half of 2012.
Okay, well, do you think that, I guess, Europe is trading on hope right now because you don't have fiscal integration? That'll take a while. And you're still hoping for the ECB to go in to do some bond purchases. I mean, they've been very adamant about not wanting to do that. So, you know, what's going to happen on the European side?
Yeah, that's a good point. I think with the fiscal union, they're trying to put the pressure on all EU member states. And they don't want to reward fiscal incompetence. And the reality is once they get the deal on the table, which is unfortunately between March and June next year, the timing's not what markets want. It's most unfortunate. That's why it could get worse before it gets better. But then once everything's aligned, and they probably have to enter into the market, the central banks globally coordinate, but once they get fiscal union in place, the IMF, EIB, ECB, EU members online, that will appease the bondholders in the longer term. Then you do the unlimited bond buying program towards the middle of next year. But markets will be extraordinarily volatile into that period, and obviously you can make money or not, or you have a defensive portfolio. That's a different story. It depends on your risk appetite. But the one thing I see time and time again is every investor is fatigued because at the end of the day, is Europe, as the headlines say, are they going to make up or break up? Our core view is that they will make up and exist in some form going forward. A break-up scenario is not our core view, but that is fatiguing pretty much most investors around the world.
Yeah, you betcha. It is Euro fatigue at this point. So, George, what about some calls out there by brokerages? Goldman Sachs last week telling us that they expect a decline of 10% in the first quarter, then trade back up to par 0%, maybe see some gains in the second half. How do you think 2012 is going to play out?
Yeah, 2012, it's all about, we've got global growth revised much lower, 2.7%. The key point here, it's uneven. The developing world 4.7 next year. The developed world 1.2, that's a European recession. Downgrades for earnings coming through. And just like as you indicated there with Goldman's, we're looking for a recovery in second half 2012. So as you get a bit more certainty around Europe, the discount to equities, make no mistake, equities today are cheap, nothing but cheap. Price to book, 1 year forward PE, trailing PEs, no matter earning yield, bond yield, they are cheap and they'll remain cheap for some time. So once you get some certainty around that, a lot of quality resources, industrials, and looking at energy themes rebounding in the second half of 2012.
Yeah, well, you know, it depends on how you gauge cheapness. Some are saying the risk out there doesn't make stocks cheap. So what do you think investors should get into, say, at the end of this year going into next year?
Yeah, well, we're going in with our standard moderate investor. We're very overweight cash. We've been going overweight cash versus equities since May. We're going to the new year overweight cash. But within the equity asset class where we're neutral, we're really looking at core quality industrials, the energy theme. In Australia, we just topped up in the banks earlier this month because there looks like some great quality dividends. We're looking for income certainty versus our peers. Aussie banks have high payout ratios, high dividends around 8.5%. Those sort of things. But it's all about the recovery in second half 12. That's where the leverage to the earnings adjustment is. That's where the leverage for the market is. And that is why at the end of next year, we have a 49.50 target UBS Wealth Management for the local Aussie market. And what that really means is we grab consensus earnings, shave 7% off consensus earnings, give it a multiple of 11.8 times versus 14.5, and we'll get to that target. But it's really going to come in the September or December quarter. The first half of 2012 is really for long-term investors or very astute traders. That's the reality, I'm afraid.
Wow, 49.50 for the ASX. That's pretty bullish. George, good talking to you.